So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to The Daily Call. Today we're going to be talking about why I believe that the cyclical end of index investing is near. In fact, I think it's probably pretty close, maybe a couple years out at the most. I think that this market is going to spell the top for index investing, and something else will evolve and kind of transpire out of the markets, potentially more of an active automated thing as far as what the next big thing is in the market. Now, for 1 minute, just try to remove yourself from being overly emotional when I say this, because I know that immediately when you saw the title of this podcast or even started this podcast, you might think to yourself, no way, no how, this guy is absolutely insane. He's crazy. Index investing is the only way to go. There's no way that you could do anything different. But for 1 minute, just maybe take one step back and think about it from a different perspective. And I'll offer up this logic over the last, let's say, 2 examples of what might have worked before, ended up not working in the future or moving forward. So there's 2 examples I want to go through, and I think this will define what index investing is right now. It's just undercover and it's very subliminal right now. It's subconscious to a lot of people, but the reality is it's actually happening. So ask any real quant fund manager, this is happening in the real market. So the first example I'll give you is the Bitcoin phenomenon and bubble that we just went through at the end of 2017. Now, everyone knows now, hindsight, that Bitcoin was a massive bubble at that time. Now, could Bitcoin continue to move higher in the future? Maybe, sure. I have no idea. But during that time period where we saw Bitcoin run up to maybe, what was it, 20,000? I don't even know what it was, 20,000 per Bitcoin. We saw the workings of the same mechanics that we see right now in index investing. And those mechanics are as follow. If I buy Bitcoin with basically this hope and dream that Bitcoin has value, which we know people bought much higher than where the value is now, if there is value now, because it's just continuing to move lower. But if I bought Bitcoin, my only hope was that somebody would come in and pay a higher price than what I was willing to pay. So this whole idea of this greater fool's theory, there's a greater fool out there that will buy Bitcoin at a higher price, and then that person thinks somebody will buy Bitcoin at an even higher price. So the people who bought near 20,000 per Bitcoin obviously thought, or whether they thought it or whether their actions basically spoke the words, and that is somebody's going to buy this at a higher price, therefore it's a deal. But the reality is that at some point, fundamentals and actual value comes back around. And what we actually saw in Bitcoin is that ended up collapsing very quickly, right? And so the last year or so, Bitcoin has been a terrible, and you don't even see it. I mean, Google search trends are down. Nobody mentions it. CNBC used to have a Bitcoin ticker in the bottom left-hand corner of the screen. That magically disappeared as well. So we don't even see this anymore. And so the underspoken or like underlying truth here is that at some point, value comes back and people have to judge things off of value, especially when we're talking about long-term equity plays, investments. It comes back down to value. What we saw in 1997, 98, 99, heading into the dotcom bubble was the exact same thing. It was just in a different market. And so we saw it during the dotcom bubble is that people were paying all of these insane valuations for startups and internet companies based on this wild expectation that companies could grow into infinity. Now, of course, some survived and some lasted naturally, but a lot of those crashed and burned because at some point, a greater fool basically was the last ending string of potential greater fools, and then value kind of self-corrected. So we've all been through those scenarios. If you haven't been through them, please go back and research them because it's really important. But what we're in right now is very much a undercover type of greater fool theory. And I challenge you to prove me wrong on this, but in many cases, there's a lot of people who are investing in index funds and ETFs where all they are doing is taking all available cash and continuously buying up the indexes. Now, at some point, this works really well, but at one point, there's going to come a time, and I think we're very close to that time, where all people are doing is just blindly investing in the indexes. Just investing in the indexes because that's what I'm, air finger quotes, supposed to do, because that's the right move. And so whether they think it or not, consciously or subconsciously, all they are doing is becoming the greater fool. And as the markets continue to go higher, it sucks in more people near the top, then more people start index investing because that's the best thing to do. And all they're doing is just buying because that's what they do. And what we see right now is we see forward PE ratios on the S&P 500, some of the highest levels we've seen, reminiscent of all the recessions and depressions that we've seen historically. We've done videos on this on Facebook. You can search our Facebook account. We show these things to you guys. And it's because people are just blindly buying up the indexes. Now, at some point, the indexes and these fundamentals are going to correct. Because if everyone was right, everyone would be rich. And right now, some people are rich, but not everyone. And so the end of index investing, I think, is going to come to an end in the very near future. And we're going to look back on this and be like, man, maybe we should have some sort of active money management strategy in place. Fool me once in the dotcom era, fool me twice. Okay, now you really, you should have learned your lesson in 2007, 2008, right? But fool me a third time. And now people are going to, I think, dramatically change their paradigm and how they invest. And I think it's going to move towards more of an active management style. I think it's going to move towards more of a shorter duration style versus these long-term index plays. Now, granted, they played out really well, and everything plays out really well until it doesn't. So hopefully it's been helpful. Like I said, hopefully I look back on this podcast maybe a year, 2 or 3 years now and say, I called it. I thought that this was going to happen. I truly believe that it's the next one to pop. And I don't know when that's going to happen. I'm not going to say it's going to happen tomorrow or next week or, next year. But at some point, it's going to correct. And at some point, it's going to, valuations are going to come back down to where they should be. And I think that that's going to be really hard for a lot of people, that pill to swallow. As always, hopefully this helps out. If you guys have any questions, let me know. And until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from optionalpha.com.